I'm Julapa Jagtiani, and so everything I say today, I'm with the Philadelphia Fed. I won't say much because I'm moderating the session, but everything I say is my own view and not the view of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. So today, in this session, we are going to talk about enabling fintech. And all the speakers on this panel are also co-organizers of this conference. They're all well-known experts in their field, and today they're going to share their thoughts on enabling fintech. So the first speakers, first Klein from the Brookings Institute, then Richard Herring from the Wharton School, and all their bios are on the website. Patricia from Columbia University, and Chris Feeney from the BPI, Bank Policy Institute, and Raghavendra from U of Cambridge. So before we start with the speaker, I just wanted to give you some basic background to introduce the session. And some of this, actually, we have heard from President Mester, who talked a lot about fintech, financial inclusion. And so I just a few more things to add. I won't take too much time. So as we know, fintech has both challenges and opportunities. A lot of benefits. The best one is really financial inclusion. And as we have heard, this could potentially enhance credit access and allowing 26 million Americans to have access to credit for the first time. And these are people who are thin files or underbanked or unbanked. And globally, my number is a little over. President Mester said estimate 1.7 billion consumers globally would, for the first time, will be able to get access to credit. So with this great benefit, it comes with some risks. And some of these risks are quite new. And this is on the right side of the slide. You see, this is my favorite picture that shows that beggars in China actually also can receive your donation using the QR code. That's one example of financial inclusion. So it comes with risk. And so there are risks to consumer privacy, risks to consumer other areas, fair lending, and these models, more data. We don't know when it's reshared and who is using the data and how it is used. So that is consumer protection is one area of risk. Also, cybersecurity as advanced technology also has allowed for more sophisticated cyber attacks. And so regulators, but also financial system also, as President Mester also mentioned, that the interconnectedness and the payment system, all these and cloud computing, cloud servicing also could impact financial stability. Also the API, now that we allow third-party vendors to go directly into your bank account and grab your data, so there is more room for cyber and information security issues. So in this session, the first two speakers, Klein and Rick Herring, will focus on fintech regulations, how to enable fintech in the U.S. and compare with other countries as well. And then the next two speakers, Trish and Chris, would focus on cybersecurity, which is the main concern, the most concern of all the bank CEOs at this time. And it has been also increasing because of this lockdown and advanced technology. Then the final speaker is Raghavendra, who is going to present to us the very recent empirical results from the survey that Cambridge University has conducted recently to report on the various fintech activities across the globe during this COVID-19. So with that, I will turn the microphone to Aaron.
Thank you, Julapa, and thank the Philadelphia Fed and my fellow co-organizers for pivoting here and putting together this conference, which is just incredibly important this week as we start to pivot our domestic political environment. I want to build on a couple comments from some of the earlier keynotes that I've heard, which I think were fantastic, but got a couple things off. And I think in understanding how the regulatory system interacts with consumers for fintechs, it's important to go back to these points. The first was what Comptroller Brooks just said. Comptroller Brooks basically said, we have a system that's working really well for those with money, which is spot on, and isn't working for those without. So the solution is to expand the box, and fintech can bring people into the system for whom it isn't working. There's a lot of truth in that. There's also a different perspective, which is that the people for whom the system are working are wealthy because the system is working for them. And the system, for whom the system is not working, that's why they're not doing well. It's causal as opposed to corollary. So one of my favorite statistics is a couple. America is predominantly not a prime country. Less than 50% of Americans are prime credits, for whom the rewards are quite wonderful. The majority, about an equal number of people are subprime as to whom are prime, and the rest are non-scored. It's roughly 40-40-20, plus or minus, depending on how you count. So what fintech offers three different value propositions to the three different groups. To the prime customers, it's trying to provide a better service. This can be difficult because the current system is quite rewarding for prime consumers. On the other hand, prime customers have a lot of funds. For the subprime, fintech is trying to disrupt services that are simply extremely expensive. This gets to another misstatement that was said earlier today, which has to do with why the unbanked don't have bank accounts. It was about trust in the banking system. This is a narrative that is old and false. The FDIC's survey of the unbanked show that the predominant reason that people don't have bank accounts is the cost. If you ask the unbanked, which are only about 5% of Americans, although 12% of Latinos and 14% of African Americans, the overwhelming reason they don't have bank accounts is the fees are too high. The second most common reason they don't have bank accounts is the fees are too unpredictable. Trust rates far lower and almost non-existent, under 5%, are branch locations and hours. So when people talk about fintech disrupting in the branchless bank, these aren't even on the radar screen of the current unbanked. Furthermore, the underbanked, a population roughly 3 to 4 times the size of the banked, are those with bank accounts but using check cashers, money transmitters, and payday lenders. Why? Because they're providing expensive services that meet their needs. So when we're talking about fintech and we're talking about regulation, there's a desire to start with the premise of the problems that face the people with money and the problems people with money think people without money face, right? It's about a 50-50 country in terms of living paycheck to paycheck or not, 40-60 whether or not you have a prime credit. I'll close as an interesting fact. America's 38% have a passport, 62% do not. I suspect those figures are somewhat correlated as well. And so when you think about these problems, you have to put yourself in the shoes of folks that don't. Fintech offers this capability to tackle for the people without money, lowering the cost of services in a way in which the regulators are still struggling because they're often starting from a premise of problems faced by people with funds or their imagination of the problem of people face that people without money face. So I'll leave those thoughts there. I'm eager to hear some thoughts of my colleagues, and we'll take it from there.
Okay. Thanks, Julapa, and thanks to the Philadelphia Fed and my fellow panelists. It's in fact been quite interesting simply trying to put the program together, and I have certainly learned a lot from the preceding speeches. I wanted to address an issue that Aaron referred to in passing, and that is why it's been so difficult for the U.S. to build a regulatory system that enables fintech. I'm not going to start from his premise that we simply are using the wrong point of view. He may be right, but I think there are other reasons to believe it's a problem as well. The pandemic has really set this in bold relief. It's accelerated the trend to digitalization that we've all noticed. Partly it's happened within banks because digitalization facilitates the new work from home regime. And it's also increasingly demanded by customers, both who worry about currency as a disease vector and who enjoy the convenience of digital transactions. But the U.S. lags most other countries in devising a regulatory framework to enable fintech. Now, the outlines of such a framework have been articulated by the Financial Services Board, and they're the result of all sorts of consultations, and they come up with two key objectives, both of which seem quite plausible on the face of it. The first is technological neutrality, and the idea is that the regulatory system should be neutral with regard to the way in which financial services are distributed. That should be determined by the market, what customers find adds the highest value and is most convenient. The second is same activity, same regulation, which Loretta Mester, I think, described a little more practically is if it walks like a duck, looks like a duck, and quacks like a duck, then it should be regulated like a duck. The idea behind that is that you don't want to see services flowing to a less well-regulated sector, and you don't want to set up conditions for arbitrage, which could take risky activities out of the bank into a sector that's not overseen and not backed up by the normal safeguards that you see in the banking system. All of this suggests that the way to go is activity-based regulation. And indeed, I think Loretta endorsed that with some enthusiasm. And it does seem to work pretty well with regard to some kinds of activities like anti-money laundering and a variety of consumer and investor protections. But it's less straightforward about how you do it when you start looking at hiving off some of the core banking functions that the controller was talking about when he was talking about unbundling the bank. The problem is bank regulation is a complex set of costs offset by some benefits. The chief benefits, of course, being access to the payment system, deposit insurance, and access to the lender of last resort. So if you take out one of the core banking services in the unbundling process, the question is, what does same regulation mean in this case? We have a pretty clear sense of the cost of regulation, but with regard to banks, it's really an institutional cost. Lots of bank regulation has less to do with a particular activity than with the safety and soundness of the institution itself. And so it becomes very, very complicated to figure out how you make it all fit in the current system. The other problem, of course, is what you do with, I guess, the predominant comprehensive sector, which is the traditional insistence on separating banking and commerce, and in applying the Bank Holding Company Act to anybody that controls a bank. Obviously, this is a major problem if you're a giant fintech firm and would like to offer financial services using your technology platform. We have three kinds of charters that may be on offer, assuming the controller is able to follow his intentions. That's, of course, the ILCs, the special state chartered depository institutions, and the new proposed charter from the OCC. So we're dealing with this in a very slow, one could say careful way, but it's not so clear whether it's being determined by the sort of lobbying of the incumbents or whether it's being blocked by the kinds of regulatory turf wars within our hideously complex system, or whether it is a genuine uncertainty about how best to proceed. We can look to China, however, and see an alternative approach. And it has produced a society that has adopted fintech more widely, and I think most people would argue more profitably than other countries. And you can follow the Chinese model, I guess, most vividly by looking at the evolution of Ant. Ant Financial was a spinoff of a very effective platform for connecting buyers and sellers of goods. It quite naturally led to the provision of payments to facilitate those transactions, and that led to making loans. Now, in the beginning, the government was entirely enthusiastic and had more or less a hands-off attitude toward the development because it had remarkable benefits. It was indeed including a lot of consumers and particularly small firms that had been excluded from access to financial services. It was able to allocate capital to small firms that were excluded, which undoubtedly increased the growth rate to some extent. The government became concerned when Ant developed large float. That was the consequence of this growing payment system. It set in place reserve requirements. And here we have a very nice example of the regulatory dialectic. Ant very quickly morphed to providing a money market mutual fund that would be outside the reserve requirement regulation, but was very appealing to consumers. It became, of course, the largest money market mutual fund in the world. And at that point, the government became concerned. And so Ant morphed once again by providing a platform for other providers. It, in effect, became an intermediary of information. The lending side was originally financed by securitizations. When the government became concerned that the securitization market was fragile, they shifted to selling loans to banks and then acting as agent for banks, using their own credit models, which are argued to have something like 3,000 different variables, and provide, in principle, much clearer results. Well, it was on the very brink of having the largest IPO in all history last week, which suddenly halted because the Chinese government wanted to apply a new regulatory system. That at least was the stated reason, though one is, I think, inclined to think about the arch capitalist J.P. Morgan's observation that everyone has at least two reasons for what they do, a good reason that they disclose and the real reason which may have motivated why it happened on the very eve of an IPO, which had long been predicted. But the final question I'd like to pose is, was it better to proceed in this sort of ex post manner where regulations were imposed after the innovations had taken root and produced measurable benefits? Or is it better to follow the U.S. approach, which has been very careful? It has involved some competition among regulators, but is a very slow process. One is tempted to conclude with a parable of the ant and the grasshopper, except that it's terribly muddled in this case because of the firm involved. And it's not at all clear that the U.S.'s regulatory system has been acting like an ant, which is making long-term provisions. So I'll leave it there. Thank you.
Thank you, Dick. So you have heard about fintech regulations. Now, the next two speakers, Trish will focus on cybersecurity.
Thank you, Julapa. I want to thank the Philly Fed for inviting me personally and for inviting Columbia to be a partner in this really excellent conference. It's been a pleasure. So I'm going to start by focusing on financial stability in the context of financial innovations and fintech, and end up talking about cyber risk, which I hope is going to give a good introduction to Chris, who's next. We all know that financial systems are inherently fragile. To function, to do what they're supposed to do. They use lots and lots of leverage. They finance long-term risky assets with short-term runnable liabilities. And they have periodic episodes of, I guess, what could best be called irrational exuberance and bubbles. And the combination of those three things, particularly in the extreme, can give us at least volatility, if not a crisis, of the kind, unfortunately, we had about a dozen years ago. The other thing that we know about financial stability is that the size of the shock and the size of the specific firm that it happens to can sometimes be pretty small. And it's really, really hard to figure out what that trigger, if you like, is going to be. But it's the financial system contagion that basically makes things unstable and unsafe. So that has led to lots and lots of financial stability monitoring of weaknesses in the system. But here's one of the biggest challenges of trying to look for weaknesses and vulnerabilities in financial systems. And that's that the financial system is constantly innovating and adapting. And Fintech, of course, is the latest incarnation of that trend. Now, what we know about financial innovation, even the ones that make finance and credit provision and payment much more efficient, sometimes also make the financial system more vulnerable to overreaching, more vulnerable to too much leverage and too much short-term debt, et cetera, et cetera, et cetera. So the question arises is, what do you do about this? And I want to wholeheartedly endorse what Dick just said about having a less fragmented regulatory structure, and his and Loretta's suggestion about thinking about this in terms of activities, particularly with respect to fintech. I think just critically important. Those things will all help a lot. But I also want to add that, in my view, that's probably not enough. At least to enable fintech safely, both for the fintechs themselves and for the financial system. And the reason that I think that's not enough is that, bluntly, innovation and fintech are just that, something new and different. They are new and different. That's the whole point. If a fintech is successful and it survives and thrives, then it's probably either highly profitable or very good at cutting costs, one or the other. 2, growing really rapidly. And 3, most likely expanding the perimeter of the financial system and financial services. Yeah, those are good things. Do not get me wrong. They'll find things. But they do not tell you very much about the risk of what happens when the trends are not all in your favor anymore. In short, it's incredibly hard to monitor downside risks of something brand new because you've never seen them. So the big challenge here is to think carefully about how you want to monitor these things ex ante and what you can and cannot measure. And here's where I want to turn to talking about cyber risk. And I want to use the example of cyber risk for a few reasons. First of all, cyber risks are clearly particularly relevant for many of the fintech innovations. Digitalization is is the name of the game for the most part. A second reason is that there is huge focus and increased expenditure on cyber risk in finance. The expenditures, the efforts are very large already, and they're growing very rapidly, in part because it is an existential threat, and not just to big bank CEOs, but for the entire system, globally, by the way. Third, the greater role of nation states in cyber attacks is changing the calculus quite significantly. It's not just about theft of data or money, but it's also potentially about disruption, just for disruption's sake. Last but not least, from a financial stability standpoint, cyber attacks are actually somewhat different than the typical attacks on shocks that hit a financial system. And they're different in a few dimensions. The first dimension is that they are intentional. They are intended to steal and disrupt. They're not an accident. They're not risk management gone amok, so forth. Secondly, they can be timed really precisely. Cyber attackers have to be in an institution system for weeks at a minimum, and then they can decide when they actually want to start the attack. last but not least, cyber shocks are different because they can be transmitted from, say, a single firm through the rest of the financial system in at least two ways. First, they can be transmitted through the usual financial contagion channels I was talking about a minute or two ago, but they can also be transmitted through technology channels as well. So the question is, if one really wants to monitor stability risk, is where those technological vulnerabilities in the financial system and where the financial vulnerabilities intersect with each other. If you like, there's sort of two complex adaptive systems that one needs to monitor if you're concerned about cyber risk. In addition, that sort of overlap and interaction between technological vulnerabilities and financial vulnerabilities are really only just now beginning to be explored carefully, just in the last few years of those efforts really taken off. And those overlaps matter. They matter a lot, both for individual financial companies, both large and small, and even more so, those overlaps matter for institutions like financial market infrastructures. I do want to highlight one effort in this direction, which is the Financial System Analysis and Resilience Center for Systemic Risk, which is a cross-industry effort, which works to assess the intersection of cyber risk and financial risk. But that's only one example, and here's where I'm completely running out of time, and I'm going to end up handing it to Chris in about 3 sentences. So I hope Chris is going to talk a lot more about this. Finally, of course, the role of innovations in fintech really matter here. After all, greater digitalization, more sophisticated use of data, particularly confidential data, and finally, greater speed, just doing stuff faster. All of those they're the basic components of many, many fintech business models. Those trends make this sort of an examination of where finance and decisions and technology disruptions interact with each other particularly important. If fintechs are going to be enabled safely, then they need to be part of that conversation. I want to finish where Loretta started a lot earlier this afternoon. I think she said point blank, innovation isn't going to stop, so we better get going. Well, let me add to that, cyber attacks aren't going to stop either. Now, the largest financial institutions have developed a pretty sophisticated range of tools to combat those attacks. And while those are impressive efforts, that's not the whole financial system. And it needs to be. And I think to enable fintech and to have it be successful and safe is going to require a lot more work in that direction. Thank you. Chris, it's all yours.
Great. Chris, thank you. And thank you, Julapa, and everyone else for having me. So I'm Chris Feeney. I'm the president of BITS and EVP at the Bank Policy Institute. There'll be a slide up in a second. I'm going to just really zip through the left side, which is about innovation and investment, which has started years ago inside the banking system. Certainly keen interest in internal development, R&D, incubator labs, innovation centers. A lot of the firms certainly invest. I mean, they did it, through a series of funds a few years ago, but also directly. What that has led to is a much more significant set of partnerships. So the unbundling may or may not happen, but the banks are really the core client for a lot of the fintech firms. And as we go on, we've seen some acquisitions. Clearly, a couple of interesting ones. J.P. Morgan, Neutrality investment. Capital One participated in the Series A round. We've had firms like TD and Fifth Third make acquisitions of firms that they really help spur through this innovation process. The conversation, though, has translated a lot to the large-scale partnerships, certainly what is going on with Google, specifically with Citi and others, partnerships with Amazon. Really a series of behind-the-scenes partnerships have made quite a difference. The challenge for the fintechs is really the next section, the middle here, and that is really the procurement and diligence process. We are in business of trust, of security, of consumer service, of protection, of safety and soundness. And to Tricia's point and the others earlier, this is a highly interconnected system, irrespective of where you enter it. And that's really one of the big challenges. There's a significant number of third-party service providers, large-scale, smaller firms, mid-sized firms, and there's a lot of oversight in the third-party risk environment. Today, for instance, the FSB released a request for comments on a consultative document around third and fourth party risk. The OCC has done the same earlier in the year in March with an FAQ on third parties. It is probably the top discussion topic we're having as a set of regulators and industry members and associations around the world on operational resilience. It's been an 18-month dialogue. So as we move to fintechs, you have to think about how to protect them and how to protect the privacy, the data, everything from consumer access to potential large-scale breaches. And to be honest, it's gotten more complex, certainly. The footprint has expanded quite dramatically, especially in a work-from-home environment. But there's still a lot of basics in here. How do I perform cyber hygiene? How do I do my regular patchwork? How do I allow certain people into the system in an authorized way? Those haven't changed. If anything, they've been ramped up in this environment that has us working from home and working from home long term. The last piece on the right-hand side is really about the changing landscape. So what a lot of sort of goes under the radar, and it's been mentioned earlier, the large banks that we represent spend billions, and I'm talking about double-digit billions on trying to protect this entire financial system from cybersecurity threats, nation-state actors, fraud attempts. The other thing that we've done quite actively in the industry is set up a set of standards bodies. So if you look at fostering standards, we've used something from NIST, but we've propagated it around the world and developed something called the Cyber Risk Institute. Very helpful for simplifying the regulatory process. And through that simplification, not only does it help the firms and the regulators focus on the high-issue, high-risk items, it helps the fintech set a goal line. They understand where to enter, what to do, and what some of the requirements will be. And, as we said earlier, having fintechs in the marketplace is extremely important. It's how innovation happens. It's how you serve your customer. Doing it in a safe and sound and secure manner matters. Another piece would be the financial data exchange, which is interesting in that it's a combination of banks, fintechs, and regulators developing standards for accessing data and securing data aggregation in a way that's actually helpful for the industry and helpful for the consumer, including all the way down to the consumer protection level. There's a significant amount of time we spend sharing information. I kid people, but I was telling everyone during COVID-19, I took a second job, and the second job was working on behalf of the Analysis and Resilience Center or the ISAC, the Information Sharing Center, or the Sector Coordinating Council, in making sure that information sharing was happening in a way that actually helped protect consumers and protect clients all over the world. And all of those are really structural. They require a lot of commitment, a lot of time. That the CEOs and the boards endorse that, and they do understand that everything the large and mid-sized firms do can really cascade to the rest of the community of banks and credit unions and insurance companies. So the work that's done there is really done for the totality of the industry, and it's done in a tiered manner so that the right amount of rigor is applied to the right size firm based on the business model that they're part of. So it's an interesting point in time. To your point, it's constant, it's critical, it's dynamic. Cyber isn't going away. The nation state actors are smart. Everything from the COVID-based themes to the latest in love-based schemes, right, which is always a way to snare people. But it works more effectively than you might think. And, as we face that, and we face an increase in ransomware attacks, or we face an increase in business email compromise, or we face a change in theme of a cyber attack under the umbrella of politics or COVID-19, we have to be really sure that we let the fintechs in and we do it in a way they understand the goal line and the objectives. So why don't I turn it over? I think we're running a little quick, so I ran through that, or we're running a little behind, so I ran through that quickly. And I look forward to some questions later.
Thank you very much, Chris and Chris. So we are the next and last speaker before we go to Q&A is Raghu, who would present the survey results.
Talk a little bit about the survey we did here at the University of Cambridge as part of the Cambridge Center for Alternative Finance, where I'm a director. So what we did was to try to see what is the impact of COVID-19 on regulators around the world. So we have a sample which is the largest in the world. It has 118 jurisdictions across the world, with about 34% in high-income countries and about another 20% in low-income countries. So, for example, we have about 70% of the entire South Asian market responding to this survey. And what's interesting, if you look at the next slide here, is that the market seems to be much, much more diverse than is typically talked about in most regulatory systems such as the US. So this big circle you see there may be a little difficult to make out. So these are the activities that fintech firms are organized around the world. So it's not just digital lending, not just competition with banks, but some of the same firms may also do things like wealth management. Some of them may do consumer services. Their business model may shift back and forth between different types of systems. So one moment, this model is basically competing with a bank. The next moment is competing with an asset management firm. I'll give you some examples of that in a bit. But over the world, the problem for regulators is huge because you're really not sure what animal you're dealing with. One moment you're dealing with something, next moment you're dealing with something completely different. How do you regulate something? Do you regulate them according to function? Do you regulate them according to the name, according to what they're supposed to be competing with? It's incredibly difficult. But overall, if you look at what the concerns of regulators have been, we'll open the next slide, please. If you look at the biggest concern, the biggest priority for regulators around the world is the area of digital payments. And that's not surprising because most of us, especially in the developed world under lockdown, we've done a lot more online shopping. When we do physical shopping, we don't really want to handle the notes. We basically, give money directly with a card or with payments. So digital payments and remittances are the number one increase in fintech usage across the world, and that's the biggest concern for a lot of regulators. But they have other concerns. For example, digital capital raising, digital banks, insurance technology, digital lending, and so on. So the next slide talks a little bit about exactly what's the difference between emerging markets and advanced economies. Emerging markets especially are where cashless transactions have taken on an enormous amount of interest, mainly because these countries don't have that many, there's not much penetration by cards like Visa or MasterCard. So mobile payments, especially direct mobile payments using phones, is really taking off in these countries. Fintech is perceived as being particularly supportive of financial inclusion and development. Right? So go up to the next slide. You have them. So if you look at fintech regulatory objectives around the world, that's what they focus on, is basically financial inclusion, mostly in emerging markets, but also in several developed economies. Market development, adoption of digital services, they take on lower roles, but as I said, the biggest is in fact financial inclusion. Relating this is what some of the other speakers have spoken about. Cybersecurity is the number one concern, especially in light of COVID-19, right? So across the world, people are worried about cybersecurity. But so that's exactly in line with what everybody else has said. However, I'd like to talk a little bit about some of the other issues which some of the people have raised so far. First issue is that of network effects. Right? We talk about privacy of data, but the fact that a few firms control an immense amount of data gives them so much power, it's very difficult for a new firm to break into that kind of business. Take, for example, a firm trying to compete with the amount of data Google has on you or Apple has on you. It's going to be incredibly difficult for them to collect that amount of data unless there is a way you can tax the data itself. That means a firm has to release a portion of its data for competitors to perhaps come in and use that data to develop their own models. Because the more data a firm has, the bigger is a competitive advantage. That's even if the data is completely private, right? So privacy and security also decrease the level of competition. The second problem is that the data itself is used in ways where you have no idea what's being done. My favorite example is an example at Apple, where a husband and wife, one is a software developer and his wife, they both got applied for an Apple card, which is actually run by Goldman Sachs, but Apple is the one which actually offers the card. And he got a credit limit which is $10,000 higher than his wife's. Why? Nobody knows. Actually, it turns out that he complained. He made a big deal about it. He has a huge number of followers. So they put pressure on Apple to reverse this particular point here. And the Apple executives a particularly interesting response. They said, we don't know why the algorithm has actually given you a higher credit limit than your wife. We're willing to overrule this as a one-off. But because we don't understand the system ourselves, we can't tell you what it was discriminating. Was it actually discriminating your wife because she's a woman? Or is it for some other reason, which we don't know? The old days, if you think about FICO scores or things like that, what do they depend on? A small number of factors. Your total amount of debt. How many credit cards do you have and how much usage you have on each of those cards? How much new credit do you apply for? There's a small number of factors. But with the new amount of data, the sheer amount of discrimination possibilities are absolutely staggering. And the final topic of changing business models. I'll give you an example of peer-to-peer business lending. Peer-to-peer lending started out as a simple matching mechanism. That means I choose what loans to apply for. So, for example, a company issues a particular type of debt. I decide whether to buy that debt or not. The problem is this business model is relatively small because the users, the investors, have to be smart in order to evaluate the firms. So, in the middle, these guys, the peer-to-peer platform, change the business model to an auto-select business model. So, for example, now when I invest my money in a peer-to-peer lending platform, I do not pick a loan. I just tell the platform, invest my money across 1,000 different loans. All of them should have an A-level credit rating. I basically put my money into a portfolio. So I'm now in the same company. I'm now using it as an asset management firm. And the number of loans you can do is unbelievable. For example, Pinduoduo, which is a company in China, allows you to split 100 yuan, which is about $12 in US money, into 300,000 loans. In other words, you have exposure to 300,000 companies or 300,000 loans. And each loan is giving you a tiny fraction of 1 yuan of interest per day, which is somehow being managed by the system these guys have to direct the money directly to your account. Right? So, are you regulating a bank? Are you regulating a wealth management company? Are you regulating something completely different? These are some of the issues which are problematic around the world. And that's my enough for me.
Thank you very much. So we have about 5 minutes left for Q&A. So I thought I would throw one general question to Dick and Aaron, but the other three also. We have seen some banks, small banks particularly, complaining that fintech lenders are stealing customers from their own backyard. And but there are some also other banks that benefit from fintech partnerships, allowing them to offer innovative products and to enhance their customer experience. And these banks and fintechs are competing, but they are not subject to the same regulations. As President Messer said, we should regulate them by activities. And Dick, when in your talk you were not sure, you said, yeah, it could work, but not sure. So as long as customers are happy, do we still have to worry about maintaining level playing field and preventing regulatory arbitrage?
Well, I think to some extent you do. It's not at all clear, incidentally, how all of this is going to play out. We may end up with a financial system that looks more like the pharmaceutical industry, where big pharma is not really so much in the business of innovating as acquiring innovators and distributing. It could be that that's the name of the game. And in fact, we have seen a lot of fintech evolving as being components of what incumbent banks already operate. But I think it's very tricky to look at this balance of costs and benefits when you're dealing with a core bank service, because, and the answer incidentally is not necessarily obvious. Should you increase the regulations on the fintechs, or should you revise bank regulations so that it is less costly and less burdensome? But those are questions that aren't even on the table. I think there's no doubt, though, that it's the small banks that are having trouble across the board because, frankly, they can't afford the kinds of technology expenditures that are necessary to keep up with the current demands. They're going to keep rising, and I think it's going to continue to lead to larger and larger institutions.
So let me just add a couple of points. One, I agree with Dick that ultimately fintech has and technology has changed to increase economies of scale. In addition, the reason we have small banks, to harken back to Brian Brooks, is because of government regulation that prevented interstate banking. That is, was only gotten rid of in the 90s. So, this is not people kind of wake up and assume we've had national banking, in fact, for generations when we haven't. It's, not quite as old as aspects of the internet. The third point I want to add is we have a lot of regulatory inconsistency within banking. So let's take borrowing money shortly, right? You have payday lenders at very high interest rates. You have bank small dollar credit, which is generally available to wealthier people. And then you have overdraft fees. 8% of Americans pay $300 a year or more in overdraft fees, whose APR is tens of thousands of percent. Are check cashers non-banks that are stealing customers because $20 to cash a check is cheaper than $35 for one overdraft? Underlying all of these issues, as Richard points out, is the definition of core banking services. One might argue payments are as core a banking service as any. On the other hand, no Americans can't wait 4+ years for FedNow to come into operation and pay tens or hundreds of billions of dollars in overdrafts and late fees and payday loans to make up that float. What you saw in China with Ant Financial and WePay was the culmination of merchants refusing to go into the interchange game with payments and technology firms coming and figuring out a better, cheaper, faster system. And I think it is dangerous to assume that regulatory barriers that will prevent innovation will be enough to keep banks' primacy in certain areas, even areas that we might de facto think of as core.
Hey, Julapa, do we have another minute, or are we?
Sure, go ahead, yes.
So it's interesting because I think the whole concept of third and fourth party risk, so I'll take it into the cyber and resilience world, is so that the banks can actually see through the supply chain and understand the third and fourth parties and how capable they are from a cyber perspective. The other aspect of these standards bodies is to make it more efficient so that the questions you need to answer, the objectives you need to hit are clear. And then it's interesting because our whole concept is to make it proportional. So as the standard bodies stand up this work, the large banks, multinational footprint, complex businesses get more rigor and more review, and the small community banks have a much smaller set of questions and the requirements are different. So at least from a resilience and cyber perspective, we're certainly trying to make it sort of fit for purpose. And that's the goal behind most of the standards work, most of the questions, all of our work with. We do work with the regulators every day on this. We work with the standards bodies every day. So I see, at least on that front, some way to scale it appropriately to continue this sort of vibrant environment.
Thank you very much. So there are more questions from the audience, but we won't have time to answer. I really want to read it to you anyway. It's interesting. So are we in a situation where we need to blow up the regulatory framework and design it from scratch to account for emerging tech considerations? Or can we take an incremental approach and add to the existing? But of course, we don't have time to talk about this. Maybe next week. But I hope that everyone will come back tomorrow.
Maybe a whole conference.
Yes, at Columbia. So tomorrow, Google data sharing with central bank and also cryptocurrencies, CBDC or Libra, right? So hope you come back tomorrow. Thank you very much, and I'll see you then.
Thank you.
Thanks, Julapa.
Bye.